Greetings, friends. This is Jon Queen with the Queen team at Coldwell Banker Realty in South Denver. Today, we're going to continue another video in our masterclass of investing in real estate with the goal of hopefully providing you with the tools you need to create financial security for yourself and hopefully that generational wealth for your family. But before we do, if you're new to the channel, please click the subscribe button and hit that notification bell right next to it so that you can stay up to date on all of our informative content, tips, and tools as we upload them on a rolling basis. Today, I'm going to walk you through what in my opinion is an excellent three-step process to identify, target price, and then evaluate the performance of real estate income-producing property in your portfolio. And I want to be clear that what I'm talking about today is single-family or apartments or condominiums. I'm not talking about multifamily commercial properties. Those have their own method of evaluation, which is the topic of another video, which we will do on the channel. But today, we will be focusing on a situation where you are looking to buy that highly rentable real estate in downtown Denver, or that condo in the suburbs that's highly rentable, or a single family home that you would like to become a landlord on. The first step when you're looking at finding potential income producing real estate property for your portfolio is to know how to screen good property from potentially noise property. And what do I mean by noise property? I mean property that either is too expensive or does not rent for enough money to make it worth your while. And so an excellent screening tool that you can use, and you can do this on your own from the comfort of your own desk or computer, is the Gross Rent Multiplier. Now, the Gross Rent Multiplier is also used in other contexts to evaluate property, but it's not a very good valuation tool. It is an excellent, in my opinion, screening tool because it's very simple and allows you to isolate neighborhoods and areas in a particular city where the rents are high and the prices are low. And so let's get into it. The Gross Rent Multiplier is very simple. It is simply the list price of the property that you can go on to Zillow or Trulia or Realtor.com, for example, and find property prices in an area and compare that or divide it by the 12-month rental income that you would get from that property. So you say, John, how do I find out the 12-month rental income on that property? Well, it's simple. The same website you went on, whether it's Trulia, Zillow, or Realtor.com or a similar platform that gave you the information on the property prices, also often has a filter that you can click where you switch from purchase to rent, and then it will give you all the rental information in that area. And you simply look at the monthly rentals, multiply that times 12, put that in the denominator, and put the property value in the numerator. And what you will get is a multiple. In layman's terms, it's simply the amount of years that the gross rent from a property would take to pay off the price that you're paying to acquire the property. Now, there's several reasons why that's usually very far from the truth. For example, as we know, just because you can rent something out at, say, $2,000 a month doesn't mean that's your net take home. You have maintenance, you have maybe HOA fees, you have other costs and expenses that can cut into that $2,000, and that could be property specific. One property that has the same price as another one maybe has HOA fees that are a couple $100s a month higher than the other property. So you can't use the Gross Rent Multiplier as your final tool of analysis, but it does allow you to screen communities. If you're seeing Gross Rent Multipliers that are, much lower in one neighborhood than another, chances are that neighborhood is a better area than others to focus on buying your real estate property. And that is step one, is area isolation, and you look at Gross Rent Multiplier. The second step in acquiring income-producing real estate property for your portfolio is to then identify properties that you want to acquire, specific properties, and approach the seller with a competitive offering price. Now, it's very important to note that in Denver, property moves very quickly. Property usually comes on the market and then is sold within the first month. Often within the first 10 days, there are multiple offers on a property. So you really want to make sure that you're not wasting your time on the wrong property, and when you find the right property, you jump on it, because you will not be the only one who understands the value of this property, believe me. So with this in mind, the first step to finally determining if you're going to make an offer on rental income producing property is to understand if there are any restrictive covenants or HOA documents that would block you from being able to rent it after acquisition. Sometimes it happens when you are in a neighborhood and they may say you have to actually live in this property that you're buying. So you do not want to get in a situation where you found a beautiful property. It seems to rent for a very high price compared to what the price of the home is, but the only downside is you can't rent it, and now you're stuck moving into this new property. So you can avoid that with the help of a professional real estate agent, and this is where we earn our money, is to help you vet those properties and understand which are the real gold and which are the fool's gold. And once you've identified the real gold and you have the really interesting property, the next and final step in acquiring the property is to submit a good offer. And that requires doing a comparable market analysis where you are looking at all of the prices for comparable properties in the region and make sure that the offer you're submitting is in the ballpark where you can at least get a counteroffer. You won't be deselected and crowded out by better offers that are coming in at the same time. And again, this is where professional real estate agents earn our money, by guiding you through that pricing strategy. And that's certainly something that we pride on doing here at the Queen team, and we're happy to speak to anybody. If you have questions on this topic, you can always reach us at queenteam@coloradohomes.com. So after you've screened your neighborhoods, found your property, and then won the offer on your target property, and you now are sitting with this beautiful property that you're able to rent, and the mailbox money is coming in, and you're starting to feel like you're creating that generational wealth for your family, and it's been successful so far. How do you evaluate the performance of that property versus your other investments? Well, there are a lot of different methods that you may see online or in videos. I have my own method that works really well for me, and that's the one I'm going to share with you right now. So the concept that I used based on my private equity background that works well for me is a concept called the investment multiple. And now we're going to break down what that is. The investment multiple is very simple. It's a fraction. It's a numerator divided by a denominator. In the denominator is the cash that you paid down for your home. So for instance, if you bought a $300,000 rental property and you paid $100,000 down payment on it, that's a large down payment, but let's use it for the sake of math. That $100,000 would be in your denominator. Over the course of the year, if you had to make other type of capital upgrades and expenditures beyond normal operating expenses, possibly that would be added to your denominator as well. But a good rule of thumb is to take the initial cash that you paid out of your own pocket, didn't receive lender financing for, that's in the denominator of your investment multiple. In the numerator, I use three key functions that I add together. The first is the net rent that you get on the property. So that is the rent that you actually receive after you pay operating expenses, HOAs, and not counting for any months when perhaps you didn't have a tenant. Just the net rent that you actually received. The second thing that I add to that in the numerator is the amount of principal that is paid down on your loan by your tenant that year, if you have a loan. So for instance, if you have a $200,000 loan, each month, ballpark, $300 or so, particularly during the first year, of the principal on your house is being paid by your mortgage. And your mortgage is being paid in turn by your tenant. In fact, your tenant will be paying you more than your mortgage is per month if you set these transactions up correctly, because why would you want to buy something and not be able to collect all of at least your mortgage and a couple $100s a month in your pocket on top of it? So $300 a month, you're actually getting added to the value of your principal. If you were to sell the property, you'd be able to recover that in the sale. It's not the bank's anymore, it's yours. And the third number that I add in the numerator of this equation is the appreciation in the value of your property. Residential property, particularly non-commercial, single family, if we're talking about apartments or condominiums or homes, these tend to appreciate. Prices go up, prices go down, but more often than not, they go up unless we're in a housing crash. And so right now, you can see monthly reports, and we'll be putting them up regularly here on this channel as well, that talk about how housing prices in different cities are increasing or changing on a month-to-month basis. So if you see that in your town, the data is telling you that home prices went up 3%, for instance, in the last 360 days, or 5% in the last 365 days, you can take a ballpark number, just add 3% of the value of your home into that numerator. So your three numbers again are your net rent after you take care of expenses and remove any periods when you're not actually receiving rent money due to vacancy. You have your principal repayment, which depending on the amount of loan that you took is going to be probably a couple $100s a month that you are now gaining. And the third is your appreciation, which is simply a percentage that you apply to the purchase price of the home. For instance, if you purchased a $300,000 home and your home, according to public index data, probably appreciated 3%, if it's in line with all the properties in the community that also went up 3%, then you know that you have $9,000 you can add to your numerator. And you simply divide that sum by the cash that you put in initially on the deal, and that's your investor multiplier. That tells you how your investment is performing against maybe other stocks or bonds or investment activities that you're undertaking. Maybe you own a business, but you're always concerned with what's your return on investment. And so this is a very good way to calculate the return on your investment, which captures, in my opinion, the four main parts of a real estate investment deal. The first part being the amount of cash that you went out of pocket to pay out of your own money. The second being the amount of actual money you received from this property in your bank account and not just on paper. The third being the amount of principal that you're recovering from the bank each year due to your tenants paying your rent and that then paying down the loan you took on the property. And the final part being the appreciation on the property, the gain in value that that property has enjoyed since you bought it. Well, friends, that is a very kind of high levels, but I think sufficient enough detail masterclass on how to potentially select, acquire, and then evaluate the performance on rental real estate properties in your own personal portfolio. So I invite you to go out and try these techniques on your own. And if you have any questions, please contact Violetta and I at queenteam@coloradohomes.com. And we are happy to walk you through this transaction. We are happy if you're in the Denver area to help you acquire these types of properties for yourself so you can grow that generational wealth. And this is what we love to do. So everybody take care, have a great day, and happy investing out there. This is Jon Queen with the Queen team at Coldwell Banker.